Hello everyone, this is Sunko, the Korean bro. Today is 2024, January 5th, and let's start reading article again. Okay, I was reading an article, but then uh, all of a sudden my mother knocked on my door, and she opened the door. So I had no choice but to stop recording. So now here I am. Uh, let's start from where we left off. Okay. Um, and I was reading an article about Google. Okay, here it is. Unlike many funds, Portion Square is highly concentrated with its $10 billion portfolio invested in just seven companies. The largest stake by a fair margin is Alphabet. The fund owns 9.38 million Class C shares and 4.35 million Class A shares, making the total value of the stake $1.92 billion. This represents more than 19% of the Portion Square portfolio. In an interview last month, Altman laid out the logic for his biggest stake. It was AI that created the opportunity for us to buy Google at an attractive price, Altman said. He suggested investor fears that Alphabet had fallen behind Microsoft and AI crushed the stock. He went on to note that Alphabet's industry-leading digital advertising business alone is worth the stock price. Investors get all the AI potential for free. He also believes that Alphabet's AI technology is competitive with, if not ahead of Microsoft's. Hmm. Altman has a point. Alphabet has a long, storied history of developing AI, and rebound of online advertising from its historic slump is already improving the company's financial results. The vast potential to benefit from AI is icing on the cake. Okay. Microsoft, we got Amazon here. Unlike its cohort, Amazon wasn't the fastest in big tech to join the AI marathon. After months of sitting on the sidelines, the company made headlines after its $4 billion investment in OpenAI competitor Anthropic. Although some investors may view the partnership as too little, too late, I see things differently. The cornerstone of the Anthropic deal is cloud computing. Throughout 2022 and 2023, corporate software spend decelerated as businesses were trying to navigate a cloudy macroeconomy plagued by inflation and high interest rates. As a result, Amazon's cloud business started to shrink. But as the best companies often do, Amazon exercised patience, waiting for an attractive opportunity to reignite growth. The specific condition from the Anthropic partnership that has me most excited is the role AI will play on Bedrock. Bedrock is a managed service offering developers various large language model and a multitude of generative AI applications, including text generation for blogs, virtual assistants, and image generators for graphic designers. With the stock trading at just a 2.8 price sales ratio, investors can see Amazon is trading at a steep discount to its 10-year average based on this measure. At just $150 per share, Amazon stock looks like an absolute bargain right now. I see Bedrock as the next phase of growth for Amazon Web Services. In 2024 could provide investors with a glimpse of the cloud platform's evolution, which should lead to further shareholder gains. Alphabet here. Advertising leader in the cloud computing giant Alphabet may be the most interesting stock on my list for potential winners in 2024. Alphabet is the parent company to the world's top two most visited websites, internet search engine Google, and video sharing platform for YouTube. Alphabet completely reimagined digital advertising, which helped the company generate billions in sales and profits. But over the past few years, competitors such as Instagram and TikTok have gained popularity, particularly in the highly coveted Gen Z and millennial demographics. This dynamic, coupled with a tough economy, caused advertisers to rethink how and where to prioritize their budgets. But amid this crisis, Alphabet found a silver lining. Like its peers that we've discussed, Alphabet saw the potential in artificial intelligence, how the technology could play an integral role in its ecosystem. Most recently, Alphabet introduced Gemini, its competitor to ChatGPT. Similar to Microsoft, Alphabet is integrating AI across its entire suite of products and services, including productivity tools and cloud infrastructure. The chart illustrates Alphabet's forward price to earnings multiple of 24.2 is lowest among the Magnificent Seven. I see this as a major buying opportunity. Multiple of 24.2 is the lowest among the Magnificent Seven. I see this as a major buying opportunity as the capital market overlooked the potential that AI can play for Alphabet's business, with the stock trading at roughly $140 per share. 2024 could be a unique opportunity to begin dollar cost averaging into position. In TWID, okay, this growth stock bet the market over the last 5 years, and shareholders could see market beating returns over the next five. In TWID, okay, what is this company? Okay, Intuit is the gold standard in U.S. tax preparation and accounting software. Okay, so hmm, accounting software. And here we have AMD. Hmm, Okay, here it is. We have Amazon here, Alphabet here, UiPath, dLocal here. Let's start with Amazon. Okay, Amazon stock I'm excited about in 2024. While the third quarter was a high note for many of Amazon's business segments, its Amazon Web Services cloud computing business reported a ho-hum quarter. However, management noted that some of the headwinds are beginning to die down while new workloads are coming online. Coupled that tailwind with Amazon's margin profile, and you got a recipe for a stock that could have a phenomenal 2024. Okay, in quarter three, nearly all of Amazon's profit measures approached all-time highs. Furthermore, they did it without secular tailwinds. With Amazon set to have a full year of high profits and a rebounding business segment, I'm confident in significantly increasing my position size. Alphabet, like Amazon, Alphabet is a big tech company that dealt with some headwinds throughout 2023. The advertising market was soft in late 2022 and early 2023 as many advertisers cut budgets to prepare for a recession. Note that the economic outlook has improved and Alphabet has lapped those year-over-year comparison. It's starting to show solid growth. In quarter second, Alphabet's revenue rose 11% year-over-year, helping its earnings per share improve from 1.06 to $1.55. This will boost Alphabet's stock throughout 2024, but it also has another tailwind: artificial intelligence. AI is a huge investment for Alphabet, and with the launch of its latest Gemini generative AI model, beating the competition on many benchmark tasks, it could be a new revenue driver for the company. Alphabet's 2024 should be solid, Investors will be wise to establish a pit position before it takes off. Okay, let's see about Shopify here. Okay, here we have it. Here. The Shopify's record-breaking $9.3 billion sales during Black Friday through Cyber Monday highlights its influence. Innovative tools such as the Retail Point and PostGo are set to further merge in store and online shopping. The Retail Plan and PostGo. The e-commerce platform is not just participating in the retail revolution, but is poised to lead in 2024. Discover how Shopify's groundbreaking Black Friday success indicates ready for a beginning of a retail transformation. With a record $9.3 billion in sales over the Black Friday Cyber Monday weekend, making a substantial 24% jump from the previous year. Shopify's performance this year delivers an impressive turnout in the ever-shifting e-commerce world. Such strong results seem to mirror the company's earlier calls for leading a transformative retail revolution. Let's see how Shopify plans to not just playing, but redefining the retail game. Shopify's tools for tomorrow are ready to bridge words. Shopify's new retail plan and Post Go checkout scanner are more than just tools. They're the back end of a seamless retail experience, merging the vibrancy of in-store shopping with the convenience of online commerce. For instance, with the retail plan, merchants get what they need for enhanced inventory management and customer relationships, leading to improved sales and customer retention. This isn't just an operational upgrade, it's a strategy vision coming to life, promising a future of sustained growth and innovation. Innovation is often met with skepticism. Shopify's retail plan and PostGo provide no exceptions. Questions arise about adoption rates, integration with existing systems, and customers' acceptance. Your Shopify's history of turning challenges into opportunities suggests these tools will evolve and adapt, further entrenching the platform and the retail landscape. Investors should closely watch all numbers coming out of the pressure cooker this Black Friday through Cyber Monday. The early results look very promising for Shopify's resilience. Analyzing Shopify's performance beyond Black Friday. Shopify's financial performance seems a compelling tune of strategic success. A 22% increase in gross merchandise volume to $56.2 billion and a 25% rise in revenue to $1.7 billion in the third quarter illustrate not just growth but also deepening market penetration. These numbers are underscored by a 36% gross profit that demonstrates Shopify's ability to adapt in the evolving landscape. These reassuring figures indicate Shopify's potential as a market leader. Shopify faces its own set of challenges, from navigating global e-commerce complexities to adapting to shifting consumer behaviors. Its ability to tune into these dynamics and adjust its strategy accordingly has long been the hallmark of its success. For instance, the rapid pivot to accommodate increased online shopping during the global pandemic shutdown demonstrated Shopify's agility and foresight. Investors should note this adaptive rhythm as a key component of Shopify's market resilience. Shopify's vision for 2024 and beyond. The company's aim appears to stretch far beyond more expansion, since it's orchestrating a retail renaissance. Imagine a digital landscape bustling with activity, where Shopify's robust infrastructure effortlessly manages a staggering 967,000 requests per second during peak shopping moments like did from a Black Friday through Cyber Monday. Such results stand as a testament to a platform built for resilience and scale. Consider Shopify's suite of tools not as mere features, but as part of a new shopping paradigm, bridging the gap between the tactile allure of in-store experiences and the boundless convenience of online shopping. This vision is powered by a formidable backend where data meets innovation, charting a course toward a retail future where every click and footstep is part of a seamless journey. The unfolding of a retail revolution with Shopify at the helm could well transform how we think about, engage with, and invest in the retail space. While Shopify's strong contender for growth in 2024, as we close the book on another record-breaking Black Friday, look toward 2024, Shopify seems ready for a revolution. While the e-commerce world buzzes with investment options, Shopify brings together opportunity and innovation with its robust performance, innovative tools, and forward-looking vision. Investors not get a share in the company list, but a stake in the future of retail. And so the question may be less if Shopify is ready for a retail revolution, whether the retail world stands ready for Shopify's next chapter. Statista notes that the e-commerce business to consumer retail market is expected to expand by 50%. E-commerce business to consumer retail market is expected to expand by 50% before 2025 from the 2021 figures. There's plenty of room for Shopify to help retailers find their way into this space and for the platform to revolutionize it. For investors, a close eye on Shopify might not just be your front low ticket to the retail transformation of a decade from a company that specializes in bringing the retail world to the digital sector. Okay, the stock rebounded sharply in the back of strong revenue growth in 2023. Many small businesses are relying on Shopify capital for extra funding in a challenging retail environment. With the stock trading at a higher valuation, investors will want to shop around before buying shares. Okay, Shopify's recent growth shows there could be attractive bargains for taking among beaten down e-commerce stocks in 2024. Platform has been a go-to for merchants looking to set up online storefront to expand their e-commerce presence, while online retail spending slowed significantly in 2022 as the consumer spending dried up amid rising inflation. Shopify bounced back strong in 2023. Higher revenue growth pushed the stock up 124% for that year. They said Shopify's improving financial results led to the stock trading at an expensive valuation of 14 times trailing revenue. The company will have to execute almost flawlessly for to justify the premium. We'll look at one factor helping Shopify's business in the short term before evaluating the share's appeal compared to other top growth stocks. Shopify benefits from a key competitive advantage. Shopify has been a high growth business in recent years. That's not likely to change anytime soon. The company's revenue, which comes from a subscription to its platform and add-on services it calls merchants and solutions, increased from $1.1 billion in 2018 to $6.6 billion through the third quarter of 2023 on a trailing 12-month basis. Shopify serves well over 1 million merchants worldwide, but just in the US, the total gross merchandise volume across its customer base accounted for only 10% of US e-commerce spending in 2022. So it still has a long runway for expansion. In the third quarter, revenue climbed 25% year over year, uh, driven primarily by growth in merchant solutions and Shopify payments. It's notable that Shopify's revenue growth in 2023 was much higher than total e-commerce spending, which rose 9% last year to reach $1.137 trillion according to eMarket. Shopify is benefiting from a small business looking for financial assistance during a challenging retail environment. Shopify's capital issued $4.7 billion in loans from 2016 through 2022. This has been an invaluable service for businesses that may not be able to get a loan from a traditional bank. Shopify succeeds when merchants succeed. It makes most of its revenue from merchant services, including Shopify Capital, payments processing, shipping, and other services, with less than a third of its sales coming from a subscription to its platforms. After more than a decade, Shopify has a lot of data that enables profitable landing decisions for merchants. Its ability to serve entrepreneurs where large banks would be afraid of losing money is a key advantage for Shopify and will provide a source of extra growth over the long term. So, other growth stocks offer better value than Shopify. Shopify's small penetration in the e-commerce market, as well as the opportunities to bring more useful features to merchants, should keep revenue climbing at a double-digit rate for a long time. It will make a great investment, but it's important to buy the stock at the right price. If you're an existing shareholder sitting on gains, you may not want to sell shares of a growing business and pay capital gains taxes, but new investors might want to wait for a better entry price. Shopify currently trades for a price sales ratio of 14, which is expensive compared to other compare e-commerce merchant service providers such as Amazon Ads and Toast. Hmm. Roku has overcome several headwinds in 2023. The stock may not seem cheap, but it traded at a much higher revenue multiple as a much smaller company in the summer of 2021. The climate is kinder for Roku and the streaming industry heading into 2024. It could roar again next year. Okay, Roku has had a great year. The widely followed streaming service stock has skyrocketed 133% in 2023 through Tuesday's close. Can it double again next year? It's never an easy fit to double in back-to-back years, and some feel that even this year's beefy gains aren't warranted. A pair of analysts downgraded Roku 2 weeks ago, concerned that the stock's big step up this week isn't warranted. One of them even implied that Roku could be losing market share, a big deal for the top dog. It's in the shade that has historically widened its market lead over rivals. I'll take the other side of that argument. Roku remains one of the more promising investment for 2024. Let's go over some of the reasons why I feel that the pioneer of streaming operating systems for TVs could keep winning the year ahead. Momentum is on its side. Okay, the Roku shares moved sharply higher last month after the company posted a blowout financial results. It wasn't a fluke. Roku came through with another beat and rise report. Okay, it's getting a bit late, so I'm gonna have to put an end to it. But I'll come back tomorrow or the day after tomorrow. So I'll see you guys. Happy Friday night and bye bye. Goodbye, everybody.